In a world of information overload, in a world dominated by biased pay-to-play advertorials, in a world riddled with fraudsters, fakes, and phonies, one voice stands out to provide reliable information to investors, business owners, and busy professionals, unbiased and beholden to no one. This is Financial Poise Radio, the spoken word sister of financialpoise.com, the internet's most trustworthy resource about finance, investing, business, and law.
Hello, everyone, and welcome to Financial Poise Radio. In a few minutes, we'll be talking with Phil DeMuth, author and director at Conservative Wealth Management, which serves its high net worth clients and attempts to save them, quote, from the depredations of the financial services industry, end quote. Mr. DeMuth is an author, most recently of a book called The Overtaxed Investor, which we will discuss. He has written many books, however, and several of them with financial professional and comic actor Ben Stein. We won't spend a lot of time talking about Ben Stein, but we will have a good time talking with Mr. DeMuth, I can predict. He made one statement that we will investigate, which I hope gives you reason to continue listening, which is, it pays to take a lifetime perspective on your taxes. What that means. Before that, a program note. That is, if you are currently subscribed to Accredited Investor Markets Radio on iTunes, Stitcher, Spreaker, or Libsyn, we're glad and we appreciate it. But please make sure to subscribe to Financial Poise Radio itself so you don't miss out on new episodes. Now, for my scintillating commentary segment, let's talk about crowdsourcing. I'd like to talk about it in two ways. First, as a new thing being applied today to old things, and secondly, as an old thing being applied long ago. So first, a new thing being applied to today to an old things, I now refer to a site called Zooniverse, spelled ZOONIVERSE.org, not .com. Anyway, Zooniverse relies upon the general public. Not all the general public, of course, it's not a polling organization. They find the more skilled and obsessive among us to help, to volunteer to help. Its most recent project, which is what made me learn about them, is to decode U.S. Civil War communications. Yes, not all that stuff has been done. And it so happens that a great trove of U.S. Civil War telegrams were unearthed, almost literally, and many of them are enciphered. So Zooniverse has scanned 15,971 telegrams handled by U.S. military telegraph office during the Civil War and put them online. You can go read them. About 5,400 of them are enciphered. Some 6 cipher code books have been also placed online. The rub is, that's not all the cipher code books. It's very difficult to decode something when you don't have the code book, and there were at least 10 in existence at one time, but now there are only 6. So the appeal is to the general public, to the more skilled and obsessive among us, to help. And I can imagine some people will be quite moved to help. I think it's a great project. By the way, it's not just Zooniverse. So if you want to find out more about it, you should look at the websites of the Huntington Library, Art Collections, and Botanical Gardens. Also involved is the Abraham Lincoln Presidential Library and Museum, North Carolina State University's Digital History and Pedagogy Project, as well as Zooniverse.org. And something like 100 of these messages were issued by the president himself. So it should be an interesting project. Okay, so that was the new thing, crowdsourcing, being applied today to old things, Civil War communications. So let's go to an old thing, crowdsourcing as an old thing, being applied long ago. For crowdsourcing was applied to the formation of the Oxford English Dictionary. As an aside, my most prized piece of personal property is a 1932 to 1935 little, and I use that word in quotes because it's quite big at 14 volumes, little OED from 1932 to 1935. It was smaller than the first edition of the Oxford English Dictionary, which came out in 1928, which was a work of generations. But still, there's Little I'd rather do with a book than read the OED and see about the origins of words. So if you look at even the third edition OED today, and if you were to come over to my house and look at the little OED of 1932 to 35, you would find a definition, and then you would find examples of usage of each word, including the earliest usage of each word. How do you suppose they did that? From 1870, when the project really got going, to 1928. How do you suppose they did that? They didn't have digital resources then, but they did have the English public. And the call was put out by Professor James Murray, who had recently become the editor of the project in 1870 and thereafter, for the public to find the earliest usages of the words and to comment and make notes on etymology of the words. A very distinct and strong aspect of the OED was crowdsourced avant le lettre. So that was Professor Murray. He was at it for several decades. There were tens of thousands of entries proposed by the general public. One man, Dr. William Chester Minor, proposed thousands on his own, sending in neat handwritten quotations and doing what I just described, suggesting the etymology and their earliest usages of particular words. And Professor Murray noticed, by the way, Professor Murray took all these notes and compiled them in something called a scriptorium, which was like a greenhouse behind his home filled with these little notes. But anyway, back to Dr. William Chester Minor. So Professor Murray became curious about this man, and he found out where Minor lived, which was outside of London, in the Broadmoor Asylum for Criminal Lunatics. Yes, Dr. William Chester Minor was an American surgeon who had served in the Civil War. Now this unifies both of the major themes of today's remarks, the American Civil War. Things went wrong in his head, and later on he killed somebody in London and was judged to be criminally insane and sent to Broadmoor. And from there he did all this fine work, some of which is undoubtedly still reflected in the OED as it has come to us. Dr. William Chester Minor and Professor James Murray, editor of the OED, became friendly and corresponded, and a book covering this really interesting tale, a short book and a bestseller in its time, 1998, was The Professor and the Madman, a tale of murder, insanity, and the making of the Oxford English Dictionary. As a result of all I have said and learned with regard to these two topics, I officially pronounce crowdsourcing to be cool. Let's get to the interview. Phil DeMuth is managing director at Conservative Wealth Management, LLC, serving high net worth clients and, as he puts it, quote, saving them from the depredations of the financial services industry, end quote. And to all my friends and former guests in the financial services industry, you have a chance for rebuttal. Just get back on this show. Phil has written or co-written 9 books on investing, most co-authored with his pal, the monotonous, in a good way, economist Ben Stein, familiar, I think, to most of us. Phil also writes regularly for the Wall Street Journal, Barron's, Forbes, the Journal of Financial Planning, Human Behavior, and Psychology Today. And there are many other aspects to Mr. DeMuth's biography, but we haven't the time. His newest book, not co-authored with Ben Stein, is entitled The Overtaxed Investor. Slash your tax bill and be a tax alpha dog. That's a lot of promise in one title there, Phil. Phil, it's great to have you with us.
Chris, thank you so much for having me on. It's great to be here.
Awesome. That's what I say every morning, by the way. It's great to be here. So your new book is entitled The Overtaxed Investor. There seems to be a message in those 3 words. I read your May 9, 2016 column in Forbes, which was entitled The Tax Man's Taken All of Your Dough. The article itemizes in great detail, just almost in bullet points, so many chunks of wealth taken by so many and varied tax bites. that even a marlin-sized income will, before it lands on the shores of retirement, be rendered a mere skeleton. That's the impression one gets. But to go back almost as far for a metaphor, George Harrison famously sang, "Let me tell you how it will be. There's one for you, 19 for me, 'cause I'm the tax man." Maybe nobody remembers that, but I do. So your book.
Wait a minute. Are you George Harrison?
No. I'm afraid I'm not even related to him.
Oh,
sure
I thought I was talking to George for a minute.
Oh, well, maybe that's a different podcast. Anyway, so your book, The Overtaxed Investor, makes a similar argument, but you also have an earlier book entitled, more confidently, Yes, You Can Get a Financial Life. Which is it, Phil, despair or hope?
Yes, I'm afraid it's a little bit of both. I was just reading the other day about how the average American, 55 to 64 years old, has in liquid assets $45,447. So that's what's going to see him or her through his 30 years of retirement. If you draw that down at 4% a year, that's about $1,800 a year to live on, plus whatever else you have, Social Security. But it's not a lot of money, really. It seems like we've entered this crazy world, and this is very much in the news. Neil Gabler just wrote a thing about how the average American doesn't have $400 in the bank to cover an emergency. It seems like we're sort of coming to two different Americas. There's one world where people have access to capital, and they're going to have comfortable lives, comfortable retirements. But then there's another America where people are people working at the cubicle next to us, but they don't have any savings at all. And these people are heading for retirement of misery. Fidelity says that you need $120,000 in retirement just to cover your out-of-pocket health care, the stuff that's not even covered by Medicare. So it's kind of strange. There's like an invisible crisis that's hitting the land, and nobody can see it. And you have to put on these special X-ray specs, and you see, oh, this person's okay, but this person standing next to him, he's not okay. He's headed for disaster. So it's very scary. And I think the solution is going to be life cycle financial planning, which is really why both these books, the earlier book on Yes, You Can Get a Financial Life, and the new book about Overtaxed Investor, are really very much the same message, which is you have to take a long-term sort of lifetime view of your financial situation and plan accordingly, so you don't arrive like a marlin washed up on shore with a lot of shark bites taken out of you.
Yeah, although in that metaphor, he was actually lashed to the side of a boat, but that's all right. So yes, a lifetime perspective on your taxes is one of your themes, but you said 55. How meaningful is the message to somebody who's 55, or what should somebody who's later on in the process do to ameliorate the situation?
Well, one of the things that I learned in the course of putting this whole thing together was that there's a very interesting time period that comes into many people's lives right at the moment of retirement. It's kind of bizarre. It all came about because I was talking to a client on the phone, and this guy had just sold like $100,000 worth of his company stock with a zero basis. And I said to him, gee, John, you must have paid quite a tax bill on that. And he said, actually, no, I didn't owe any taxes at all. And I thought, wait a minute. How can you sell $100,000 worth of stock at zero basis and not have to pay any taxes? And he said to me, well, I just retired last year. I don't have any income. Haven't taken Social Security. Haven't taken any money out of my IRA. So I'm just living off of the cash I have in my bank account. So that was my only income for the year. Plus, I've got a mortgage, so I've got a few deductions. I'm married. So the whole thing, I'm in a 15% tax bracket, and I pay zero taxes on capital gains at 15% tax bracket. So I thought, well, that's astonishing. I had no idea such a thing was possible. And then I realized that there is this whole interesting period that crops up between the date when you retire, and this guy was like 62, and age 70 and a half really, when you have to start taking Social Security and you have to start taking these required minimum distributions from your IRAs and 401ks and all these tax qualified accounts. You have a window of, it might be 8 years, might be 5 years, where if you're very creative, you can do a lot of tax planning to save yourself from higher taxes later in retirement. So there's actually quite a bit that people can do in their 50s and 60s, or I'd say really more in their 60s, to do very astute tax planning. And the tax code seems relatively stable enough to let us do that right now. So it's a great opportunity, and it's one I didn't even know existed.
It sounds like the key there is building up a load of cash so that you can survive while you're not making any money at all, and then offset that lack of making money against whatever asset realization you end up doing. I mean, is that kind of a key?
Precisely.
Yeah.
That's one way of doing it. Here's the problem, and this is a problem that I didn't know existed. But it's a problem, and it's not a problem. You know, if you're a minimum wage, if you're a barista at Starbucks, this is not your problem. But if you're a more prosperous, high bracket type, this is a problem for you, and that is that once you hit age 70. And you have to start taking Social Security, and you have to start taking these required minimum distributions from your retirement accounts. The required minimum distributions aren't just flat. The curve that you have to take them on slopes up. So you have to take out a greater and greater percentage of your IRAs every year. And that's not a big deal, you know, if you're 3 years into it. But if you're 10 years, 15, 20 years into retirement and you have a big IRA of some kind, suddenly the IRS is saying, wait a minute, you got to take this money out. And that's all coming to you as ordinary income. And if you have other income of whatever kinds, if you have a pension, if you have deferred compensation, whatever else you've got, if you're working still, whatever else you have going on, suddenly you can find yourself being put into a higher and higher bracket, even while you're in retirement. And of course, that's horrible. We have a very steep tax code. It's pretty friendly if you are making very little money, or if you're making even just the average amount of money, if you're making, you know, $48,000 like most Americans do. But if you're making $200,000, $300,000, $400,000, these are the sharks that are coming after you. So it's very important to look ahead and see what's coming so you can plan accordingly.
All right. Speaking of planning accordingly, and maybe we're looking at somebody a little bit younger. Certainly when we're talking about Tracy Trieger, a guest on my show, we're talking about somebody younger, but she was a recent guest, episode 71. And she's Senior Director of Corporate Strategy at Syndicated Equities in Evanston, Illinois, or Chicago, Illinois. Anyway, Tracy focused on 1031 exchanges as a way to build up wealth for one's heirs and minimize taxation on the growth of such wealth. Do you think those are a good thing to do? And at what point in the lifetime perspective might one do that?
Sure. Well, of course, she is the big expert on the 1031 exchanges, so I would defer to her in all things. I'll probably say something stupid that will get me thrown in jail.
I want to warn the audience that if Mr. DeMuth does say something stupid, you do have episode 71 to correct him with. So we should all feel very comfortable with what's about to happen on this show. Please go ahead.
There's a tax wizard named Robert Keebler, and he's in Milwaukee. And one of the things that he discovered, he was looking over all his list of clients, and he had to do a presentation on, I think it was the estate tax. And he realized that every one of his clients who had an estate tax problem was somebody who'd gotten there because, and here, by the way, having an estate tax problem was a good thing. It's somebody who had too much money.
Yes.
This person had gotten there because he had exploited statutory tax shelters that are built into the tax code. And the 1031 exchange is exactly one of these statutory tax shelters. It's typically used in the area of real estate. And a smart use of it is that you've got some property, maybe you've developed it, and the time has come to sell it. But you could even have a negative basis in the property. The property could have a zero basis. So everything you sell it for could all be capital gains, and of course, then you've got the IRS lined up, and they want their 25% or 33%, depending on what state you live in. So you don't want to pay these taxes. You want to defer these taxes as long as possible. So in steps the 1031 exchange. And this is just a system whereby you can go through an intermediary. You never touch the money. And then what you do is within some time period, I think it's within 45 days or maybe it's 6 months now, you can turn around and use the proceeds to buy a new property. And by so doing, the cost basis, becomes part of the cost basis for the new property, but you don't have to pay any taxes right now on it. You can simply defer it until you sell the new property, which might be years out. And in fact, when it comes time to sell the new property, you can then do another 1031 exchange. So imagine that you're lucky enough to work in a field that is one of these statutory tax shelters, like real estate, where you're constantly in the business of, developing shopping malls. You can go from, one shopping mall, then build a bigger shopping mall, then another bigger, more prosperous shopping mall. And you just keep pushing the cost basis forward, never paying any taxes along the way. So it's a brilliant maneuver to avoid getting socked by taxes every time you want to make a move and just being frozen into whatever you bought. It also works, I don't know if you talked about this, but you can also do it with art. There's a big art auction today at Sotheby's, and if you want to, if you have a Liechtenstein that you bought years ago that's appreciated a lot, and you see a Picasso today that you'd like to buy, this is your big opportunity. You can, instead of selling the Liechtenstein, paying a big capital gains tax, and then buying the Picasso, you can do a 1031 exchange, assuming you can get it set up correctly, and then use the proceeds from selling the Liechtenstein to buy the Picasso. And again, not have to pay the tax along the way. Now, there's a million rules in this, and you can't just wing it. You've got to go through an accountant, attorney to make sure you're doing everything correctly, because if you screw it up, you're going to have to pay anyway. So do it right, but if you do it right, it can be very tax beneficial.
I think Tracy used a term, it's a technical term, for doing something to uncle through this tax, the 1031. I can't repeat it because I don't remember it, but it was something uncle. So I invite everybody to listen to that program because it does go into the details further than we could here. I'm going to quote you on your website. You write, "Never give cash to charities," end quote. I got to say, you 1%ers are harsh. You did go on. There was another sentence after that, which recommended that you should donate appreciated assets instead of cash. Well, why and what is an appreciated asset?
Sure. Well, I had a client last year who said he wanted me to raise $1 million for him because he wanted to write a check to a charitable foundation he was interested in. And I said, wait a minute, not so fast here. If I raise $1 million, there's going to be capital gains you're going to have to pay on it, and it's going to be a very expensive proposition. You may end up spending, $1,250,000 with, $250,000 of that being taxes in order to make $1 million donation. So I said, here's a better way. Let me search through your portfolio for all of the lowest basis assets we can find, which is to say the stock you bought when it was cheap, the Apple stock you got at the IPO. You bought the IPO for very little that's now worth a boatload of money. Let's give those shares over to the charity and let the charity sell them. The charity doesn't have to pay taxes on this stuff. So then you still get the $1 million tax deduction for donating the money to charity. The charity still gets the $1 million to do whatever it wants to do with it. But these capital gains, these $250,000 in capital gains that were just hanging over your head, they've just been vaporized. They just disappear. So gifting to charity is a wonderful move. It's a great way of discharging capital gains. Never mind all the other ways it can be very, very useful in tax planning. And it may even occasionally do some good if you give money to a good charity, which is harder than it sounds.
Well, I was thinking about that. With that $250,000 not paid to the feds, you could make a substantial contribution to the Haymarket Opera Company in Chicago with its great Baroque repertoire. I don't know why I thought of it. I guess because I really like their music. So yes, you
a
could
great
do some
use.
good.
I like it too.
Yeah, you should go. They'll have a program in the fall. So you point out to raise something else that I think qualifies as a hackle. You point out that according to the Tax Foundation, taxpayers spend 6.1 billion hours and $168 billion complying with the federal tax code. I happen to know that the Estonian government, granted they're Estonians and there's fewer of them, does the taxes for all the citizens, which they can check online, 45 minutes, they're done. Why can't we do that or something more efficient than what we do?
Yes, well, I think I'm going to move to Estonia. I think they probably have excellent fish there. It sounds like a good plan.
It's a little close to the bear, if you know what I'm saying.
That's true. That's true. But this whole business about the tax code being so impossibly complicated, 74,000 pages of rules and regulations that basically nobody understands. Nobody understands at all. But this, you might say, what's going on here? And I think that the horrible truth is that this is a feature of the tax code rather than a bug of the tax code. In other words, how did it get to be so astonishingly complicated? Well, it's because there are lobbyists there, which is basically just people like us. People like us want to have things done. We want to have fewer taxes for ourselves. We want to be exempted from taxes of various kinds in our personal lives and our businesses. And we also want additional taxes to be paid by people that are not ourselves. So we want our competitors to pay more taxes. We want to have new taxes placed on them, fewer taxes placed on us. And of course, everybody else feels exactly the same way we do. They want to tax us and not be taxed themselves. So as this goes into the sieve of Washington, D.C., and money going into lobbyists, all of this money ends up in congressional campaigns. Congressmen take money from these different interest groups, and then they, in their wisdom and their proceedings, they make little tweaks to the tax code, and the tax code, as a result, becomes hugely complicated. And it needs constant attention, constant visions and revisions, and more work for, I shouldn't say attorneys, we love attorneys, but more work for tax attorneys, more work for CPAs, more payments for the lowly taxpayer. So this is just, unfortunately, a feature of the world we live in. And much as we would like to see a flat tax or a simple value-added tax, like somebody like Ted Cruz was hoping for, I don't think it's very likely because that kind of cuts off a lot of the revenue stream. If we had a stable tax code that was very simple, you could fill out on a postcard or it was just done online, there are a lot of people that actually wouldn't like that. So I think a complicated, overwrought system is here to stay.
Well, I should mention in this connection that yours truly authored an article in AIMKTS.com, accredited investor markets.com, which is one of the financial Poise sites, entitled "Thank You, Senator Coburn, Senator Coburn's Tax Decoder." Senator Coburn, in his last month as a senator, wrote a highly specific criticism of the IRC, the Internal Revenue Code, which he entitled the Tax Decoder, and the article links to it. It's a very well-intentioned, thorough document, whether you're on the side of the angels or the devils, and I'm not going to tell you which side is which with regard to the tax code. Everyone can learn from it, those who want to more, and those who want less. So I guess I should ask you, you've written a lot of books. I would say that there's little your eyes have not seen, given that you've been paying such close attention to taxes, among other things, over your writing career. Can it be that there were any surprises while you were writing or researching the Overtaxed Investor, slash your tax bill and be a tax alpha dog?
Absolutely. I mean, I was continuously surprised by it. And it's funny that many of the people in the financial planning field, investing field that I've talked to, I found that they were just as remarkably ignorant of the whole thing as I was. So when you have a 74,000-page tax code, there's always a lot to learn. There's a lot to do. The thing that really got me writing the book was when I realized that I had been paying far more taxes than I needed to, even in my own area of expertise, such as it is, which you might say would be investing. I own mutual funds, I own exchange-traded funds, and what I realized is that these investments, which are widely owned, you might say this is how people are investing these days, we're throwing off a lot of taxable income that I did not need or want at this point in my life. And I took a look at my 1099 DIV form, and I thought, look at all this money. I've got to pay taxes on all this stuff, and I wish all this stuff would go away. How can I not have to pay all these taxes? And I realized I should point out that my pal Ben Stein and I have a couple of times had the opportunity to go to Omaha to visit a guy named Warren Buffett, who is like the ultimate master of the tax code and how to run a tax-efficient operation. And I realized that Mr. Buffett has a company called Berkshire Hathaway, and it famously, even though the stock sells for $225,000 a share, it hasn't paid a dividend since, what was it? I think 1960. In 1963, I think they paid a 10-cent dividend, and that was the last time they've ever paid one. But the net result of doing business this way, and Berkshire Hathaway is a huge conglomerate, is that it's an incredibly tax-efficient investment. You own Berkshire Hathaway. Berkshire Hathaway owns a whole diversified portfolio of companies. The companies themselves pay dividends, but because they're sort of pass-through organizations to the conglomerate itself doesn't have to pay taxes at the same rates we do on it. And so it basically, Buffett's able to reallocate all this capital year after year after year in a huge growing enterprise. And meanwhile, if you own Berkshire Hathaway, pays no dividend, it just sits there on your investment statement, and it just seems to get bigger and bigger and bigger every year, but there are no tax consequences associated with owning it up until the day when you decide you want to sell it. And then, of course, you have to pay capital gains. But for many people, they might end up owning Berkshire Hathaway their whole lives and end up dying with it. And at that point, they get a step up in capital gains on the Berkshire Hathaway. So it goes to their children, and they've never paid taxes on it. And their children can sell it the next day and not have to pay taxes on it and use the cash and do something else.
Yes.
So I said, holy cow, this is a very smart way to invest. Why don't I try to take a page from the Warren Buffett playbook? He seems to have done okay with it. So what I started realizing is that instead of owning all these mutual funds and exchange-traded funds that make these taxable payouts every year. Oh, and parenthetically, last year, as a textbook example of the problem, mutual funds were typically flat or down for the year, and yet they still issued big capital gains payouts that you have to pay taxes on, even if you didn't buy or sell a single share all year long, because they had trades within the fund, and inside the fund, the benefits of all those trades, so to speak, get passed on to you, even if the net result was it loses money. So I said, I don't like that so much anymore. I want to own individual stocks that don't pay dividends. So what I did from there is I said, well, does this really work or not? And I found a great article by a couple of University of Chicago finance guys, and they looked at what happened if you just bought every stock in the S&P 500 that didn't pay dividends and did this over like a 30-year period. How would you have done? And the answer was that you would have not done as well as just owning the whole index if you didn't pay taxes. But if you did pay taxes, even like at a 15% rate, you did quite a bit better. And, I'm in California. Higher bracket people in California pay all-in capital gains taxes of more like 33%. So suddenly it became a no-brainer. I just started searching out these zero dividend stocks, and this seems to be a better way to go for high bracket people that are staring at big tax bills every year where they don't really need the money for their daily living expenses. They have other sources of income. So this was the thing that got me excited to write the book in the first place. As I said, this is a great way to go for the right kind of person. It's not ideal for everybody, but if you're paying taxes that you don't need to be paying, this is a good end run around the whole problem.
Well, that raises something that you were partially raising in my mind earlier when you talked about the 74,000 pages of the Internal Revenue Code. Lawyers are exposed to malpractice liability. I imagine, I don't know much about whether registered investment advisors are, I assume they are. And in both cases, probably for falling beneath the duty of reasonable care in advising a client so that the client actually is harmed by, say, losing money. And now you're telling me that not buying dividends or buying stocks that don't pay dividends is for some clients systematically better because of their situation paying taxes. Doesn't seem to have been wisdom that was generally known. So and definitely the clients were harmed by doing this. This raises a different issue to me, though. How can a tax lawyer be guilty of malpractice when there's no way in hell to understand 74,000 pages of the Internal Revenue Code? I suppose in individual cases, something is as well known that he should know, but it does pose a problem with having the duty to understand something that one is unable to understand in toto.
Right. Well, the great thing about being in the financial services industry, up until today, basically, because now they're thinking of changing it, is that, when you go to open an account at, any of the major banks or wirehouses, the first thing you do is you just sign a 20-page document in .001 pica type. And what it says there is if you're unhappy for any reason, don't go to court. We've got it pre-taken care of you because you'll go straight to arbitration, and the arbitration will be run by people just like us. And what we find is that when people do go to arbitration, that the financial services people that are sort of presiding over this, they tend to like what the financial advisors were doing. They don't tend to like what the clients are saying. They don't tend to give these cases much credence. So it's great from the point of view of financial services, but I think they're going to take this away and say, wait a minute, no, we can go to court instead. And that's, of course, a horse of a different color. But if you think about all the fallout after the internet telecom blow up in 2000, and all the financial advisors that were saying, oh yeah, you got to buy petstore.com and CMGI, all these stocks that went from $1,000 a share to zero or just 10 cents a share. And people were happily buying all these up and getting richer and richer and richer until they were bankrupt. There was almost no repercussions for this, just as there were almost no repercussions after the financial crisis in 2008. So far, advisors have been protected, but I don't know how long that's going to last for.
But a move is afoot to disallow PLU arbitration. PLU, of course, meaning people like us.
Exactly. And I'm not sure that's a bad thing. I mean, it would be a bad thing for me, I suppose, if somebody wanted to sue me for some reason or come after me. But in general, I think it would be in the best interests of the customers. And that's really what it should all be about. So, but you're right. It's very tough. And even something like a strategy like this, buying zero dividend stocks, to me, it suddenly seems like a great idea. But I know almost nobody that's doing this. Otherwise, I wouldn't have had to write a book about it. I would have just gone to them and say, so let's get this going. So I think it's a good way to go. But of course, there's also the risk that somebody else could become president and could have a big mandate to change the tax code, and they say, okay, well, even though it hasn't, capital gains have been able to defer them indefinitely, we're going to start taxing capital gains even if they're unrealized. I mean, these proposals get kicked around all the time. So even this strategy could turn out to not be a good one. So I don't necessarily recommend doing an all-in bet on any one strategy, but I think it's something worth considering if you're paying a lot of taxes right now and you don't need the dividends and the coupons for ordinary expenses and living.
Well, it is another way to address your taxes with a lifetime perspective, one might say.
Exactly.
Well, Phil DeMuth, author of The Overtaxed Investor, Slash Your Tax Bill and Be a Tax Alpha Dog, along with many other books and many learned articles. Thank you so much for being on the show today.
Great being here, Chris. Thanks for having me.
All right. Been listening to Financial Poise Radio. I am Christopher Cahill, the host of Financial Poise Radio. Financial Poise Radio is produced by Stephanie Strings. Thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.